9 ways to know if a penny stock is a loser. Owning penny stocks, also called small cap company stocks, can be a wise investment if you don't ignore telltale signs of a loser. In today's video, I'm going to share 9 ways to know if your penny stock is a loser. And I'm going to share how my own choice for a penny stock investment became a loser. Welcome to Retire with Randy. Episode number 4, Penny Stock Losers. Penny Stock Loser, 9 ways to know. Like, comment, subscribe. So let's get right into the 9 signs that a penny stock is a loser. Number 1, low trading volume on most days. This sign is more about the amount of dollars traded each day than the number of shares traded. A small cap company with 1 million shares trading in a single day sounds like a lot, but it's not. If the share price is only 3 cents, for example, then a mere $30,000 was exchanged the entire day. And if the volume drops to 100,000 shares for the day, then only $3,000 was exchanged all day. That kind of low volume indicates a serious lack of investor interest and demonstrates that the penny stock may be a loser to avoid. My dog of a loser stock, in its current incarnation, is called FuelPositive, and it trades on the TSX Venture Exchange in Canada as NHHH, the chemical formula for ammonia, NH3. It also trades in the US over the counter as NHHHF, where F simply means that it's a foreign stock. For years now, FuelPositive, even on its busiest trading days, has barely exchanged $40,000 or $50,000. Nowadays, FuelPositive is trading at near all-time lows, around 2 or 3 cents Canadian. If the trading history of your penny stock shows that cash exchanged between investors is typically in the tens of thousands of dollars per day, or even less, then you might be looking at a loser. The next sign that your penny stock is also a dog like mine. Number 2, over promotion. Many small cap companies will engage in aggressive promotion of their stock through email marketing, imaginative social media posts, special appearances in video news interviews, and independent blogs that promote the company, all of this to generate interest in the company's story and to encourage investment in the company's stock. Very often, the emails will be from a partner firm that touts the potential future value of the company or suggests that investing now is an opportunity to get in on the ground floor of a potentially explosive new market. Beware of the hype. My penny stock, FuelPositive, has the distinction of being overhyped in each of its incarnations, from the days when the company was privately held as Feel Good Cars to when the company went public and became Zen Motor Company, and especially when the company changed its name to eStore Corporation. And now, since 2021, known as FuelPositive, when the company switched its focus to green ammonia used as fertilizer by farmers. One notable early example of the overpromotion was the anonymous e-store blogger, affectionately known as B, who unabashedly presented a photo of himself with a brown paper bag over his head in order to reaffirm his anonymity. Some counterbloggers referred to him as Baghead. B or Baghead, you choose what to call him. He thought he had the proverbial tiger by the tail, investigating reports of venture capital investment in the company, secret deals with Lockheed Martin or with General Motors and Ford Motor Company, an association with NASA, U.S. military partnerships, reposting questionable stock analyst reports, and sharing Freedom of Information Act responses to official requests made by members of his blog regarding the company's dealing with the federal government in the U.S. But B's hyping of the company's miracle product, the fabled electrical energy storage unit, the ESU, did little more than assemble a small cadre of ESU fanboys who, after B gave up his blog, exist now on two alternate Slack chat rooms. First, FuelPositive Chat is actually listed on FuelPositive's company website. This Slack chat is sometimes referred to as Fib's Place because it is run by a former follower of the anonymous e-store blogger B. Fib, now known as FP Chat Admin 1, had for years gone by the moniker Fib, ironically, a special nickname he acquired in childhood. The other Slack chat is FuelPositive with a dash, where the outcasts from Fib's Place hang out. Any serious FuelPositive investor will eventually discover these two blogs. At Fib's Place, the FuelPositive CEO even manages to drop in to answer questions from time to time and to promote his latest strategic actions for the positive future of the company. In fact, he dropped by on a Monday over a month ago to answer questions and assure Fib's small cadre of fanboys that things are progressing nicely and that 2025 will be a great year for investors. Of course, only time will tell. One interesting thing, a month ago, as the CEO signed off from Fib's Slack chat, he made a parting, seemingly desperate plea for any qualified investor fanboys to apply for a seat in the current $800,000 private placement where investors may purchase new shares, which includes a warrant for another share for each share purchased. More on private placements in a few moments. If your penny stock shows evidence of proxies overhyping the company through emails, social media posts, online news interviews, or fanboy groups, instead of underdog, you just might have a real loser on your hands. A low, wallowing in the mud kind of dog. That brings us to the next sign that a penny stock might be a loser. Number 3 of the 9 signs, lack of transparency. This is a big sign of trouble. Companies that are not transparent about their financials or business operations may be hiding something from investors. Missed reporting deadlines, delayed annual shareholder meetings, or leadership shakeups with little or no explanation are sure signs of trouble brewing behind the scenes. When confronted about a lack of transparency, company leadership will often reaffirm their commitment to communicate with investors and promise to do better and communicate more fully and more frequently. But far too often, the assurances of transparency fall short, disappointing shareholders over and over again. Many transparency issues are present with FuelPositive. We don't even have to go back to the pre-FuelPositive days of the big reveal of the issue, the promise of an all hell breaks loose moment that is about to happen soon, or certainly will happen before the start of the year 2010, well before summer, pick your year, after Chinese New Year. Well, you get the point. Financial success is always imminent, just around the corner. eStore Corporation changed its focus to green ammonia for fertilizer and changed its name to FuelPositive in February 2021 with a new co-founder, as if 2021 was when the company was founded. FuelPositive has not been transparent about its business dealings. For example, the company's last annual meeting was held in July 2023 with no transparency about why the legally required annual general meeting was never scheduled for 2024. Then, after the 15-month mandatory time limit for conducting an annual meeting had passed, the company finally announced an annual meeting would be held in January 2025. But that announcement fell flat with no transparency about why. Official annual meeting documentation was never filed or distributed. But 2 days after the CEO's Q&A at FIB's Slack chat, which I mentioned earlier, the company announced in a news release that the annual and general meeting will be held virtually on March 18th, 2025 at 4 p.m. Eastern Time. I had planned on attending, but again, no paperwork was filed and no official notice has been given to shareholders about the meeting. I believe they must file official annual meeting paperwork and give shareholders notice and ballots for board member elections at least 21 days in advance. FuelPositive was forced to reschedule the March 18th meeting, and now the new annual meeting date is set for May 6th. Again, no explanation, no further press release, not even a visit to FIB's place to explain the situation to the faithful cadre of fanboys. In addition to the annual meeting drama, in February, a cease trade order was issued in Canada due to the various missed deadlines about financial reporting. The company finally issued an explanation after the cease trade order was initiated. They claim everything will be completed and the stock will begin trading soon. In fact, they finally uploaded their delinquent financials and the cease trade order was rescinded. But as of March 10th, the stock still isn't trading on the TSX Venture Exchange. Whew, that's a lot of murkiness and missed deadlines. Well, if your penny stock company isn't transparent about its business activities or not timely in its disclosures and reporting, it just might be a loser like mine. The next sign that your penny stock might be a loser, number 4, lack of institutional ownership. If institutional investors like mutual funds and hedge funds are not investing in the company, it could be a red flag. Now, many of these types of institutions have rules against investing in low-end penny stocks in the first place. But there should be some form of institutional ownership to indicate a broader support for the company. For example, a small cap company, if they don't yet have institutional investors, may reach out to venture capitalists for support. If they win funding from such groups, it could be a sign of support and interest in the small cap company's future until a broader base of institutional investors develops. In the case of FuelPositive, there doesn't seem to be much institutional interest, if any. Of course, because institutions shy away from penny stocks, this sign of a loser stock becomes more significant only after years without institutional support. If we start the clock on FuelPositive's institutional support with the company's name change in February 2021, then it's only been just over 4 years. Is that enough time to attract institutional investors? What about your penny stock? When will it achieve significant institutional support? If not in the cards, well, you could be holding a loser. The next sign of a loser penny stock, number 5, lack of analyst coverage. Penny stocks are often not covered by reputable analysts, which can make it difficult to obtain independent analysis and research. Sometimes a small cap company will partner with an analyst who has a poor reputation and questionable or sketchy information and research about the company, suggesting that the company is a diamond in the rough, worthy of taking a risk, the next Apple or Starbucks. So if your penny stock company shows up on a rogue analyst report with glowing ratings for a bright future, but no reports from reputable stock analysts, beware. The danger is that the people who pump the stock are prepared to dump the stock quickly. They have no emotional attachment to your beloved penny stock. In fact, they're counting on recruiting as many investors as possible who will become emotionally attached to the story and to the idea of a new world-changing technology. The hope of rapid financial success and the heartfelt sense of being part of something wonderful, even awesome, a game changer that will make the world a better place. Emotional investors rarely sell their shares which drives the share price higher when being pumped, but only temporarily, as the stock pumpers soon become stock dumpers. This pump and dump activity has happened several times during the history of my beloved penny stock company, as FuelPositive, as eStore Corporation, and as Zen Motor Company. Sometimes the company partners with an analyst who writes a glowing review, or sometimes a third party not directly related to the company becomes involved. Either way, the stock price gets pumped up as more and more investors are drawn into the story. Then, the company takes advantage of the price pumping by issuing a private placement, selling new shares of the company at the temporary higher share price in order to fund its operations, because they have yet to have any significant revenue. To date, the CEO of FuelPositive has raised well over $60 million in new capital, which he proudly touts as a major accomplishment. Unfortunately, as any good stock analyst would advise, raising $60 million is hardly an achievement if there is practically zero revenue over years and years of fundraising. In 2021, not long after eStore Corporation changed its name to FuelPositive and changed its focus away from electrical energy storage to on-farm green ammonia production technologies, a penny stock newsletter started pumping a new startup that would revolutionize the world through its novel green ammonia technology. At first, they were coy, not revealing the name of the stock, unless potential investors would pay a subscription fee to their newsletter. They pushed out forward-looking data about potential huge profits through what turned out to be FuelPositive, which generated a lot of investor interest in the company. The share price surged from oblivion to around 30 cents a share. Of course, the FuelPositive CEO pounced on the opportunity and brokered yet another private placement, selling new shares and significantly diluting the company for the umpteenth time. The share price eventually retreated back into oblivion after the private placement was fully sold and the company went back into radio silence. Is your penny stock company releasing glowing analyst reviews that show a bright future, but only with forward-looking predictions? Are there long periods of silence in between fundraising and promotional activities? If so, you might be looking at a loser. As a counterbalance to analyst predictions for a bright future that never happens, the next sign of a loser penny stock is number 6 of the 9 signs: poor performance history. Companies with a history of poor performance or stock price declines over time may be more likely to continue to struggle. When a company suggests that there will be financial success year after year, the performance history will make it clear. Either it's a success or it isn't. Like professional baseball, where they have statistics For every player and for every aspect of the game, financial analysts track every conceivable statistic about a company. And those statistics tell the real story. Don't ignore financial history when considering a penny stock investment. My penny stock, FuelPositive, traded at over $6 per share in 2009 when the company's name was Zen Motor Company. I bought my first few shares less than a year later in 2010 for $2.35 a share, thinking it was a bargain price for a promising company. Over the next several years, the share price consistently lost ground after each private placement dilution and after each year of no revenue. Take a look at this graph of the share price history. The company's share price has fallen from $6 in 2009 to near all-time lows of 2 to 3 cents in 2025. Hopefully someday, FuelPositive will achieve financial success. But today, it's a loser. Does your penny stock have a staggeringly poor performance history? If so, it is no doubt a loser too. Many companies struggle to achieve acceptable share price growth, but at least they have revenue. But what if they never sell anything? That brings us to the next sign of a loser penny stock. Number 7 of our 9 loser signs: no earnings or revenue. Companies that are not generating any revenue or earnings are less likely to be successful in the long term. Many startups take a long time to build revenue in order to achieve earnings or profit. But if months turn into years with no sales and no profit, the company is probably a loser. There's really not much to say about this sign of a loser penny stock. Selling a product and building revenue and earnings, in other words, making a profit, should be the main thing any company strives for. If your penny stock company is like FuelPositive, with years and years of no revenue, no earnings, well, enough said, it's a loser. The problem of no revenue just might be from a lack of mission focus or from constantly changing the company's mission, which leads us to the next sign of a loser penny stock company. Number 8 of the 9 signs: an unclear business model. Companies with unclear or unproven business models may be more likely to fail. Sometimes a company simply cannot succeed at their chosen product or market focus, so they switch to something else. And when that something else fails to bring financial success, they switch things up yet again and try something new in an endless cycle of changing the company's business model. FuelPositive started as a privately held company, Feel Good Cars, manufacturing low-speed electric cars known as neighborhood electric vehicles, or NEVs, for sale mostly to customers in the United States. After a few years of marginal financial success, Feel Good Cars went public and then changed its name to Zen Motor Company. 0 emissions, no noise. In an effort to develop highway-capable electric cars, the company hooked up with a Texas firm, eStore Incorporated, privately held by a small group of investors led by Dick Weir, who was close to marketing a solid-state battery known as the ESU, or Electrical Energy Storage Unit. This association ultimately resulted in Zen Motor Company buying out 70% or so of eStore Incorporated and then changing its own name from Zen Motor Company to eStore Corporation. They ceased their low-speed car business to focus on the development of the ESU with the hope of getting back to highway-capable electric cars someday once the ESU was proven successful. And other applications for the ESU were compelling. Electric grid energy storage, decentralized electricity plants, backup power batteries, longer-lasting batteries for cell phones and laptop computers, the military, space applications. The opportunities for marketing the ESU seemed endless. Unfortunately for investors, the ESU device was a complete financial failure, and the company had to try something else. Because the solid-state battery didn't work out, maybe the technology could be developed for manufacturing better capacitors used in electronic devices. That too failed for lack of finding a manufacturing partner who thought that making a new type of capacitor could be profitable. With that failure, the company went dark and the share price plummeted to around a penny. eStore Corporation desperately searched for a new product, a new mission, and they found it. Graphene technology was the new wave of the future. They entered into an agreement with a small company from England led by a YouTuber who demonstrates many scientific curiosities, including the wonders of graphene technology. But within months of entering into the merger or takeover agreement, the company inexplicably withdrew, leaving the English Mr. Wizard puzzled like a jilted lover.
Hi. So I want to tell you what happened between eStore and FWG, and the transaction's not going ahead. Now, there was some confusion over what that transaction was. We like to think of it as a merger. They always described it as an acquisition, but it doesn't really matter anyway because it's not going ahead. So I was told to say why the transaction has ended, and the wording I was told to use was mutual agreement that we couldn't find a common understanding. That's what I was told to say. Now, the NDA restricts me from telling you about the content of the negotiation. It restricts me from telling you about the relationship between the companies, and that's all well and good. But I can tell you about what my worries were prior to going in that negotiation, and my worries were just the same as everybody else's worries. That is eStore real? A lot of these smaller exchanges, these companies, they just raise money for paying the directors' salaries. And this company's been in existence for 17 years and raised $50 million and have nothing to show for it. As I say, I can only tell you what my worries were, and that merger is mutually not going to go ahead. So, thank you very much for watching. I hope it was of interest to you, and the FWG eStore transaction is dead. So we'll be continuing, obviously. So thanks again.
Finally, eStore Corporation hooked up with a Toronto college professor who had developed a new technology for making green ammonia used in fertilizers, among other applications, including as a fuel. So the company changed its name to FuelPositive. A deal was reached with the professor's team. New shares were issued, diluting the company's ownership, and for the past 4 years, on-farm production of green ammonia for fertilizer has been the new focus and mission of the company. Unfortunately, yet again for investors, the new business model seems to be failing. Has your penny stock company tried many different ideas and failed? If so, you probably have a loser on your hands. Now finally, maybe the biggest sign of all that your penny stock is a loser, number 9, repeated dilution of owner shares through private placements. Companies that constantly raise new capital but never seem to generate revenue or make a profit are clearly struggling. Without any profit or revenue, they must issue and sell new shares in the company, often done through private placements to qualified investors. Typically, what happens in a private placement is that a company offers one new share near the current market price, which also includes a warrant for a second share at a specified higher price in the future. So, if the share price increases, the company stands to secure a second wave of capital funding down the road. And of course, investors must endure more dilution of their investment to fund these warrants. FuelPositive, in all of its incarnations, has repeatedly diluted the company with private placement offerings so many times it's hard to keep track. The reality is that 2 or 3 private placements is enough of a sign to indicate a loser penny stock, if profitability doesn't follow. Well, there you have it, the 9 signs that your penny stock is a loser and not a wise investment as you approach retirement. I speak from personal experience, having owned my loser stock for almost 15 years. I'd like nothing more than to see a complete turnaround for FuelPositive soon. But so far, it's a complete financial failure. I just hope that we're not headed for a desperate reverse stock split. If you are nearing retirement, then you'll probably want to reconsider investing in penny stocks that exhibit even a few of the 9 signs of a loser. I'd love to hear about your experiences with penny stock investments. Please drop a comment, like this video, and subscribe to the channel. I hope to see you for the next video at Retire with Randy.